You must have heard of this term quite often when you read about a startup raising money or were questioned by an investor on burn if you were outraised capital. Simply put, burn refers to the cash spent by a company in excess of revenues generated for any given period. Usually, you will come across companies speaking about their monthly or quarterly burn figures. For most people, burn could come across as a negative outcome. Let's address that for a second. Having a burn rate is not necessarily a bad thing. Let me explain this through an example. Traditionally, business got done based on expected profitability at a transaction level. For example, if Mr. A manufactures a product for 5 rupees, barring extreme cases, Mr. A would never transact to sell the product for any less than 5 rupees. However, in new age business models, the focus has shifted towards profitability over the expected lifetime of the customer, expected being the operative word. More on that a little later. Now, this means that the business may enter into a transaction that might not yield immediate profits due to deep discounts or other customer acquisition costs, but they expect to eventually turn profitable with the same customer over the expected time of relationship that the business expects to have with the said customer. Continuing with our example, if Mr. A operates on the more recently prevalent business models, he would be open to sell the first few products at a loss if he believes that the induced brand loyalty or habit to use the product will lock in the customer for a longer period and is confident that the customer is more likely to buy the product at price points that would prove profitable to the business. I think it is now safe to say that burn is not always a negative outcome. More often, it is a conscious decision made by entrepreneurs after evaluating the business risks attached to such decisions. Understanding this metric is important for founders to take calculated risks and make necessary maneuvers to help a business see returns. This is also a metric that founders need to be well versed with in conversations with investors, as they are called on to showcase how the business model is capable of generating a return on the investment after the phase of burn that may be anticipated. You might also encounter the term burn multiple. It is a variation of the burn metric that puts into perspective the growth that accompanies the burn. This could be a highly relevant metric if you are in the early or growth stage of your business. To put it in simple terms, it tells us the incremental revenue that is generated for every dollar or rupee of burn that the business has. This metric introduces the flavors of capital efficiency and cost of growth more accurately than a burn figure. The formula is simple: net burn for the period divided by the incremental recurring revenue generated for the same period. But there are a few things you must keep in mind before you attempt to compute the burn rate for your business or portfolio. Incremental recurring revenue is all the new dollars flowing into the business, but this should be adjusted for any dollar recurring revenue that is also lost or churned in the process. This will ensure the true growth of the business is captured. For early stage startups, the burn multiple could range from 1 to 5x or maybe more depending on the industry and the revenue models. While it could largely vary for all companies, it is in all cases expected to decline and move towards the zero mark as the business matures. This is a vital metric to track across various stages of the business to ensure there's a healthy growth, and could prove to be a good metric to showcase to investors as you progress along the various rounds of funding. You should note that the burn multiple is relevant in the context of businesses with a business model that has predictable recurring revenues. In all other cases, you may need to evaluate the scale at which you are likely to recover your fixed cost, which is your burn, and track your progress towards achieving it. Now that we understand what burn or burn rate is, let's take a look at how you can evaluate your financial position using it. The most common usage of the metric is to evaluate a runway for a business. Runway is the time your business has after considering the rate of burn and current cash before you exhaust your reserves. The formula is current cash divided by the burn rate. This is particularly helpful on two fronts. One is to look inwards to better your budget, your spendings, and assist in aligning with the entrepreneur's plan to raise fresh capital. Two, this could be a projected runway to showcase an investor the length of continuity the investment is likely to offer the business. We at Prequade have encountered numerous instances where the founder had to introspect on their burn to make strategic decisions. While it is important for you to compute the burn accurately, we believe it is studying your burn that gives you more actionable insights. So how do we do it? Dissect it. Attention to detail is crucial. Break it down into the most logical units before you draw any inferences. Your burn is bound to be made of various components of spends to achieve a multitude of outcomes. It is necessary to understand the commercial viability of each spend, and in some cases, where you are looking to extend your runway, criticality and impact on deferring or cutting down on certain spends on the overall business needs to be independently evaluated. This approach to analyzing will provide you with a granular view of the business to action on. Track it like a trader. Understanding and taking decisions is one half of the story. It is equally important to constantly track this metric to ensure there are no deviations from what you earlier assumed. This will help you course correct in real time and gives you the luxury of being proactive to tackle adversities.